Good morning, traders. Good morning, everybody. I hope you survived the week so far. Ryan is off for a few days. We have a half term here in the UK, and he's taking care of his kids. So this is Cayman, going to be your host for the next 3 days, unless he's getting bored of family, taking care of his family, and he joins me before the end of the week. But we will see. All right, let's get stuck in. There's a couple of things to talk about. Well, the geopolitical front is still so uncertain. A lot of foreign governments are trying to soften down or at least calm down or have the situation wait for the humanitarian aid to complete or to last longer, but the people on the ground and those directly involved still don't seem to be wanting to bury the axe right now. So we need to keep an eye on those events. Not going to go any deeper into that, but we know that there are still very much a risk for what's going on in the global markets. This being said, and I'll have a look at that later on, we have seen this market being quite sanguine again, and stuff like oil, for instance, gold also losing some of its shine. But still, I mean, it's still very nervous. Still, we don't know what's the next step is going to be. So keep an eye on those things like gold and oil. Over to China. So the Chinese government is really planning on kicking in a lot more injections into the economy. The Chinese stocks got a little bit of a boost overnight because the legislature is planning to raise the fiscal deficit ratio to 3.8% from where they prior were thinking of keeping it at 3%. Of course, that's like a double-edged sword somewhere. The stock market took it as a positive. Also, the fact that Hong Kong reduced the stamp duty on stocks trading from 0.13 to 0.1%. That also gave a little bit of a boost on to the Asian stocks. But then on the other side, the currency itself is not really impressed by the fact that they are continuing to water down the global the government finances, increasing debt and things like that. So it's a bit give on the one side and take back equally on the other side. Hong Kong also said that they are going to cut the home purchase tax by 50% to 8.5%. Their housing market is also in big trouble over there. We've seen various articles coming out over the past weeks or so, and they are now trying to revamp that site as well. It's all stuff that is going to have to filter through over time. It's not going to remedy anything right now, but it's something that we keep an eye on, because especially on the investor side, if you take Hong Kong and China as one package now, even though they still have different separate currencies, but if you take it as one package, and if one day the investor stands up and says like, okay, now we are starting to see better data, we are starting to see stuff turn around, it could all of a sudden return the situation in favor of the currency. Right now, that is not yet the case. As a matter of fact, Country Garden finally officially defaulted on one of its dollars bonds. So we could still have to go through worse before things are getting better over there. Right, that's for China. Japan and Mr. Kishida is also very keen on continue to spend the country's money. So now tomorrow, he is supposed to come up with a firm plan to for tax cuts, and one of the news wires thinks that they know what's going to happen, and that is going to take the form of a 1-year income and resident tax cut starting June 2024. That's the Sankei Newswire reporting that just a few minutes before the start of the show. So he's continuing to water down to spend money. There's more money to that will be spent. By the way, this package is supposed to cost them 33. Hang on a minute. It's supposed to cost them $33 billion or so. So we're still, as we have been talking many times about it already, we're still in this situation where the government is pushing on the fiscal pedal, where the MOF is trying to take care of the yen's weakness, and the Bank of Japan, we still don't know what they are going to do next week. So dollar yen, we'll have a quick look at it, but it's very anemic right now. That for Japan. We've got all those earnings out. I'm not going to talk too much about them, but we've seen a big difference between what happened in Alphabet and Microsoft stocks. But I'm going to leave that to the closer equity market watchers. I'm sure if for people in our community, if you go onto our S&P and indices room, that they are commenting a lot about those things. By the way, I mean, our community is really expanding and having a lot of interesting rooms right now. So for those who are following here and not yet part of our community, I strongly advise that you give us a try, guys, because there's a lot going on there. Okie dokie. I think on the news front, that is about what happened overnight. So we can get stuck into the data. What did we have after the last flow show yesterday? We had a bit of Canadian new housing price index, slightly negative. We'll have a look at the Canadian dollar, of course, today ahead of the Bank of Canada. We had the ECB Lagarde. She's still, how shall I say, is she going back to the more dovish side? No, but is she leaving the more hawkish side? I'd say yes. So she really comes over now saying that for the time being it's enough. Those hikes, and they have to see, but she's not yet giving up the inflation ghost. And with the ECB tomorrow, we're of course going to talk about the ECB closer tomorrow, but there's a bit of uncertainty starting to creep in, as we've said yesterday as well, about what they could do about the APP, the PAPP, and stuff like that. I'm going to have a closer look at that tomorrow morning. But if you look at some of the European crosses, they have been trading lower because of a lower euro dollar yesterday, but some of them are still holding up relatively well, one of which is going to be directly impacted today, and that's the euro Canada. Okay, the manufacturing PMIs and services PMI out of the US yesterday, a bit of this divergence with what we've seen in the Eurozone. Again, bit of divergence with what we have seen in the UK area as well. And guess what happened? The dollar came all the way back to where we were before we had the setback that we saw on Monday, and that despite the US yields not completely reversing either. So as I was saying on the face yesterday, I don't think the dollar is dead. I think it's at least not yet. I think it's a case still of the less dirty shirt, and in this case where we see those PMIs, it's actually a shirt which looks a bit greener than the red ones in the Eurozone and the UK, for instance. So we had a comeback in the dollar. I'm going to look at the stuff a little bit later. Richmond came in a bit weaker, but completely shrugged off by the market. Bit of a we have to look at all those auctions, yeah, because as I said, the U.S. Treasury is still issuing a bunch of auctions. A bit of a low one here. I don't know why. It wasn't a shocker, but it wasn't really great either. So we leave that a bit in the middle of the. If we look at the 2-year yields as well, they've come back roughly to where we were before before this auction. No big dramas, but a little bit of a low one here compared to where the market was at the time. API didn't change, even though it was a bit of a draw versus an expected build. It did not change the picture in oil. I'm going to have a look at oil as well today because there's interesting developments there, especially in the light of the geopolitics. Moving on to the Australian CPI. Well, Bullock is a bit more hawkish than Lowe ever was, and apparently with reason. And we are seeing this Aussie CPI being quite sticky, even higher than the expectations. So the Aussie has a bit of a lift overnight. And then happened what happens lately with most of the CPI and inflation data coming out. And that's why I'm saying that, yes, even though the fight against inflation is not completely done, currencies are not reacting in a similar way to what they did when we were in a complete inflation fight. I think now, as I've been saying already today, not today, but a couple of times before, I think we are much more watching, I wouldn't call them real data, but the street data, the growth data, rather than inflation, for the longevity of any move in the currency. I mean, okay, the global picture is still, this could still push the RBA to raise rates. And against that outlook, we could see that the Aussie dollar is gaining a bit of strength versus other currencies and stuff. But if you look at the Aussie versus dollar itself, it took an hour. It went up straight after the announcement, and an hour later we are already unwinding this move. So be a bit careful if you really trade inflation data. I'm not saying it's not going to impact the currency. It will, but it may not impact it for very long anymore. Okay, so this is just a bit of a warning and something that we noticed over the past inflation releases in various countries. Right. Japan, not a lot to mention here. Positive, but we are more looking at what BOJ is going to do next week and where the government is spending all its money. Spanish PPI still negative, less negative than expected, less negative than the prior, but still negative, coming down. So those inflation pressures are still coming off a little bit. And then we have okay, just before we go to the German IFO, Swiss who has not been good of late, and yet the Swiss franc is not suffering a lot. Yes, we have a move in dollar Swiss, but if you look at Swiss versus other currencies, it's still doing good. That is still geopolitics. That is still SNB keeping an eye on things. So the Swiss is not yet impacted by this. I'm hopeful that one day we can trade the data again in Swiss franc, but apparently it's not yet today. German IFO, a bit better than expectations, but as duly noted in our room and as I posted as well on X, we are still below expansion levels there. It is a bit of a relief. The relief in euro lasted for about 15 minutes and had about an impact of 7 or 8 points and pips. And since then, we're already 25 lower again. So that is how the market views those numbers right now. You can be green on numbers, but still keep an eye on the overall picture. The same has happened yesterday on the European and UK PMIs, right? You get some green shoots somewhere, but for as long as you stay below the 50 bar, it still means that you're not in expansion. Okay, so that is something that we have to keep in mind when we look at data. The private sector loans in the Eurozone still weaker than expected and low. This is low, okay? This is a relatively low number. So that did not help the euro either this morning, and helped the several factors in several currencies this morning that you not necessarily need to buy dollars as such, but the rest, the other currencies are doing enough of the heavy lifting to make the dollar look better again. That is my takeaway from what happened yesterday and overnight. Okay, next, the mortgage data. They are showing pain and stress, but is the market reacting to them? Not that much of what we've seen over the past weeks. These are weekly data, by the way. So next, what are we going to look at? So you have more housing data here. They are relatively important out of the US, but they're coming at the same time where we will have the Bank of Canada. And let's move straight over to some charts, shall we? Through some picture. Yeah, thanks Jamie for the guild auction. Is that right now? Yeah. How did that pan out? Where is it? Here. 3 billion. Yeah, well, a decent bit to cover now. I wouldn't say that's a bad auction, to be honest. Yeah, I got it. Thank you. Okay, let me move over to the rates and to the Bank of Canada. Okay, so Bank of Canada, we had a quite hawkish McClem until last week when the CPI data came out, and we've been trading lower. That was below expectations, below the 4%. We have to know that the Canadian rates are above 5% right now. Their target zone is also around that 2-3% zone in inflation. So we are still well above, but it's taking the direction that they want, and we are starting to see positive real rates, of course, due to this inflation going down faster than what the Bank of Canada was thinking. So as a result of that, the expectations on the moves for their rates have been screwed down again. Let me just look at them. I think it's a 0 chance for a move today. Let me check that again. No, there's actually a 20% chance for a 25 BP hike and an 80% for the for a standstill. It's likely that they are going to keep their hands still, but then we are going to go to the statement, see what is changing in there. So because we know that McClellan was relatively hawkish of late, are we going to see something in the statement that still reflects that? Or is he going to go a bit more neutral, which is my sort of base case for today? Or is he doing 180 and says like, okay, we have seen now inflation going down, economy doing good, but we could be at the end of the road, in which case the Canadian dollar will likely get a slap around the ears again. So it's been trading, let's say, a bit closer to oils, but it's not a very clear correlation yet. But since we had this Canadian data out, I think it's around here somewhere. It's clear that dollar Canada is on the rise. Canadian dollar is on the weaker hand versus a lot of other currencies too, and we are pushing against interesting levels here. This is your 4th of October high. 137.85, and this is a trend line which is coming in from that 139.80 over there. This is your zone for this afternoon. It's very, very close by, but anyway, I mean, it's still going to have an interest when we will be hearing from the Bank of Canada. If it breaks and holds, let's put it that way, then we're probably on our way back to 138.55, 60. Also seeing that the dollar is globally doing quite all right there, and is still pushing up as we speak, versus everything. So this is your immediate zone level here on the dollar Canada. If McClem says anything or stays on the hawkish side, we could see a quick retest, because the Canadian dollar has a tendency of moving quite a bit. So we could see a retest of this, call it 137, 136.80 or so zone, if he really presses the hawkish rhetoric. But I think the market is ready today, and that's my case anyway, is ready today to buy dips in this, even ahead of tomorrow's US GDP, which we will talk about tomorrow, but could have a quick outlook for that, because there may be some real implications there for the dollar. But anyway, I think for the time being, there's going to be buyers down here on a return down here. So, and I would probably be one of them if I get a move back down to, let's say, 137, get some stops out of the way, 136.80, 136.70. That looks to be a pretty good area. If in turn they really surprise and they hike and they stay hawkish, then I think your zone of no return is 136.25.40. If it goes below there, then something should have changed here, or we are in for a massive stop run. But it's not my base case. And even if they would surprise us and hike those 25 BPs, then I think this market is really going to think this is the last one. It would put the Canadian dollar in a better light, and being a relative high yielder as well versus a lot of other currencies. But it's not my base case for today. The other one, if McClem is changing his stance a little bit on the Canadian dollar, is this EuroCAD. We have also seen here in this EuroCAD that this is part of the oil, part of the risk of, as I've been saying, that we're seeing those euro crosses tick up at the start of the week. They're giving back some yesterday. What we see here, they're giving back some. No difference than versus other currencies. But still keep it in mind that when risk is doing badly, euro tends to do okay. So unless they are very hawkish at the Bank of Canada, this thing could retest at some stage just above 140, 146s. That's how it looks anyway. All right, and we're trading not too far from the immediate support right now, 145.5. But I think there's always a risk of them being a little more hawkish, and if it comes back down here into the just below the 145 zone, which is in line with that 137 in dollar Canada, there may be some buyers pop up again, trying to fish for some bottoms. Here, I think the zone of no return is a big word, but the make or break in the shorter term is going to be 144.5. Again, where did we hear that before? All right, that for some of the Canadian pairs. I was looking at the Canada yen as well. Oh, it's on the same page here. I was looking at the Canada yen as well. But I mean, good luck trading trading yen these days, because the dollar yen is really pegged to 150 right now, or just below. But it should change soon. But if you look at the Canada yen, so it may be a clean mover since the dollar yen is stuck. It may be a clean mover if the Canadian dollar picks a side, right? So this is one that is that we could keep an eye on as well. And we are not too far from interesting levels. I'm just going to show you quickly and zoom into that. The daily cloud, Ichimoku cloud, is around that trend line support, okay, which comes in at around, call it 108.50, 5065 is your support zone. I'm going to take it out for more clarity. 108.5065 is your support zone here on the Canadian yen, okay? And on the resistance, it's 109.55. So we are in between, hanging a bit low here. That's below a trend line that we had here. It's been traded a bit, as you can see in the past. It's been traded a bit, this trend line. So we are below. That's 109.10. That's your immediate pivot of the day. So above or below, it's likely going to retest one of those outside levels, okay? And I would argue if they say anything really weak on the Canadian front, we could have a quick retest of 107.5. If in turn they keep the hawkish rhetoric, looking at where dollar yen is, and people are expecting, and me included in a way, are expecting that sooner or later this 150 is going to go, then you're probably going to retest 109.55. If that goes, then really we're talking about 110s again. And then it's over to the Bank of Japan, really what we do with it into next Tuesday. So that for some of the Canadian pairs, there's a lot more, but I'm not always following all of them. So as I said, let's look at oil a bit, because, and not so much because we are at important levels. Actually, thanks Mark in our room for keeping such a close eye on and having an absolutely great trade on it as well. Mark went short towards the spike highs here. Well, just a bit below, but I mean, this was really a good level here at 90 bucks to observe. It's double top now, and we are getting back to support levels, 82s, and this 81.5 is going to be important on oil. Despite what people in the Middle East, Saudis and stuff are saying or trying to keep this thing up, this is really trading a lot with what's going on on the geopolitical side right now. And this is what I'm saying every time about the market having collective Alzheimer, right? I mean, you trade an event, but then if there's no fresh news or no worsening, most of the time this market is undoing the risk of the event in the next sessions. Now, we're probably going to strand here. That's my base feeling, that we are going to strand here for a while before we know what's really going on in the Middle East. If really the situation worsens, this could easily get back higher. But if you look purely on today's supply and demand side, I'm thinking that this has not enough strength to stay high in a natural way. This is the feeling that I'm starting to get with oil. Really, we had those ramps higher. Everybody thinking that it should go above 100 bucks. Well, it didn't. And now even with some geopolitical uncertainty really ramping higher, we couldn't hold the 90. So that is telling for me. That is really telling. That's what I wanted to give you on the oil side. Yeah, gold. Dimitris, Aussie CAD. Not really. Yeah, I mean, I'm not really following Aussie CAD. I sometimes do, but yeah, that's exactly what I said, right? I mean, you have an inflation move, and then all of a sudden it's all gone. And I'm going to be saying, and I've done it actually, not today on the Aussie because I was asleep, but I don't mind counter trading some inflation data, to be honest, right now, especially if they are higher. No, I'm not ignoring you, Ali. You know I'm not ignoring you. How can I ignore you, Ali? I'm going to come to it. Don't worry. On gold, so this is what I was saying. Those resistances, we fell shy of 2000. This was the first support. I showed that in the room, and we really tagged it. So Now, this is your level that you're watching for further development on gold in those low 950s. If that goes, then I think there's a deeper setback possible back down into the 25, 40 area on gold. If the bad situation flares up again, then I reckon we are in for a retest of this zone here. I'm not sure if it's a viable break that we're going to have. That's only the future that will tell us. But we now clearly see where the buyers are lined up, okay, or where the support is, or where those who were short counter trading this are willing to buy back. So this is starting to get an interesting level in gold. Silver is hanging around this trend line. I'm not going to do much with it right here and now before I see the US GDP tomorrow. I think this could be a driver, and actually a very good GDP is going to put this lower and probably provide a good opportunity for me to get back into what I sold in this zone here, because I'm a firm believer that good economic data are better for silver than they are for gold, for instance. Right. Let's look at what you guys are doing. Ali, first of all, you were first, yeah, with your Kiwi question. Where are you? 58.44. That's here. Okay, that's back below this. That's around this level. Yeah, you're really trading short term, are you? What does that mean? Well, I mean, you anticipated the 50% of the move. Okay. Okay, yeah, that's not a bad one to have, because in line with the Aussie, it's coming back down. The thing is, where do you put your stop? Yeah. Yeah, 58.05 is very well. I mean, 58.05 is lower than where we traded here. Of course, if it breaks, we are going to go lower again. But your real support is really 15.20, right? We never say here what people need to do or have to do, or we can comment on your position. But if there's something that I may, I mean, if you can, because Ryan as well, but me for sure, I'm using the slice and dice strategy quite a lot. If it would go down here and you take profit at 05, I mean, perhaps you could only do a partial take profit and put a trading stop just above 58.20 again and try to stay in it if it really breaks. That is something that I would plan to do if I would be in such a position. I guess if you start to get back above 58.40, 45, it's probably going to go a little bit higher again. But for the time being, we're in a range. The thing is, again, and that brings me back to my global feeling about the dollar isn't dead yet, is that we're finding resistance in those pairs quite often still. And this is your Aussie. You fly above on the CPI announcement, and then spend the rest of the Asian session and the start of the European session to come back. This is where we got the announcement. 63.50 is trading 63.30. I mean, this is how much now one really can trade in inflation data, especially in the side of the outcome of the data. Okay, this is what I mean. So for me, that was a bit of a fakey above 63.80, 90. And that's your resistance again on the Aussie dollar. I'll have a look at those pairs in detail ahead of the US GDP tomorrow. But look, I mean, the overall direction is still there. And then you take stuff like the majors, and I'm slowly getting to your cable, Brand. Don't despair, okay? If you look at the majors, right, we've broken out of the channel here. We had a big setback on the US dollars. Globally on Monday, everybody leaving the ship, everybody scared of the US yields having hit highs, and the herd of followers of big bond dealers, not saying panicking, but shaking out a lot of their positions. And then what happened? You come into the next resistance and finished. And we are going already back down. We are already back below, well back below this 106.3540. And now we are back somewhere into one of these channels. I'm not saying this euro cannot bounce, okay? We have ECB tomorrow. There, you think maybe US danger before GDP? We have the ECB tomorrow, and as I said, there is enough uncertainty around the ECB for me personally, at least. Other people may of course differ, but for me, there's enough uncertainty around the QT stuff, because they're supposed to make a decision and only start to do real QT next year. But there is something that tells me there's a fair percentage of chance, let's put it that way, that they say something about it tomorrow. So I'm a bit cautious on the euro. I am, as people know in our room, I am a bit short of it, but I did take at least partials on it on this move here. We are on a little bit of support. There's a bit more coming in around 105.5, and then around 105.25. The dollar is bid, undeniably bid, so we can see those levels, no problem. But I want just to remain cautious and not be like in oversized positions going into ECB and US GDP tomorrow. So we have tomorrow, euro dollar should really be on the move. Your cable brand, I'm not even sure if that's a real one. I've just put it on there for a bit of fun, but it does look like we're finding resistance in what may start to look like a shampoo trade or so. But anyway, I said in the room as well, I think we retested, and I showed that yesterday in our room. We retested this top end trend line, and we stopped just shy of the what I still think is a decision zone on the cable. Yes, we went briefly above, but rejected it strongly once. So this, to me, this 123 figure a half now or figure 40. I thought it was figure 20, but we had this bit of a stop run. Is really decision zone for the sterling. The day that we start to move back really above it, I think something will have changed, and likely that will be a change in dollar economic growth, in my opinion. In the meantime, retest yesterday, failure, bang, and we're back lower. As people know in the room, I'm jobbing it from the short side. I'm also, it's not an anger trade, but I'm a bit disappointed with the euro sterling yesterday, which went to take our stops out. And now it's trading back to where we left it before. But anyway, I still pretty bearish on sterling. Cable here, once we've broken through this 121.8590 zone, didn't look back, and this is now your resistance, 85.90 on the cable top side. I think you can already add now the 121.5. Interesting thing was before we went higher there on Monday, and I was saying it in the room as well. We used to have those bids here just below 121, the figure. I think those bids came up to just below 121.5, and then they went to market on Monday. And then yesterday we came back to test it, and we stopped shy of it. We had a little bit of a rebound, and this morning it doesn't seem like those bids are still there. That makes me think that they have gone to market here. So those bids are not there anymore. So your support here is 121.10, 120.90, and then all the way down to those levels here. But really, if it breaks through this line, it could be seen as a bit of a neckline, right? Or is it a real one? It could be seen as a bit of a neckline. I think through 121.10 already, and we are really not far of it. It could see this acceleration to below the figure. It's going to be a very interesting watch again, because here undeniably there were bids below 121 the figure. Okay, so keep an eye again on what we do just below the figure on the cable. Okay, I've been jobbing it. I'm been taking a little bit back as well, and I'm still looking to sell rallies, but I will again not be in a very big position ahead of the US GDP, because you never know. So oh, there's one thing I want to show you, and also the reason why I like to be short cable again is those differentials. Look at what they have been doing. We've been like, okay, they're trending lower, they're trending wider. This is why I'm still rather a rally seller in sterling than a deep buyer in that currency. But look, despite what's went on those US yield setbacks, the differentials have been widening, and we are now a bit in a risk zone again. So if you look at your cable move, just don't look any further, right? I mean, this is really something I really keep on my page constantly, because it's a really good guide for me. And then I move over to the currency and see where I can find levels. Yeah, Jamie, absolutely. You have to keep an eye on it, because if you look at the euro, for instance, where are they? Oh, did I? Oh, yeah, I think I've done something bad. So if you look at the euro, for instance, they've shot up there, but they are also coming back down. Your euro is back down, but less significant than cable. And look at the impact it has on euro sterling, for instance. So I mean, I'm not saying that everything is like plugged into to those differentials, and I've already been saying don't bank your trading only on interest rate differentials. There's a lot more going on, but for me it's one of my guides. Okay, all right. There's just one I wanted to show you, because and that the people in our chat room can find on our page. This is one of the nice features that is now on our webpage as well, is the option market. I always look ahead of events to what the options are pricing. And yes, we have event risk. This is your overnight, okay? This is Bank of Canada, and actually includes also the US GDP tomorrow, which makes it a little bit more interesting, I think. So yes, we are higher on the event risk, okay? The overnight is anyway a bit more volatile than any other picture. If you look at, for instance, on the 1 month dollar Canada, we are not any higher, because that includes a lot more and a lot more periods of high intensity and low intensity. So your volatility is always much more much smoother in the long end than it should be on the short end. So yes, your volatility is higher, but the option market is still not stressed out. I mean, if you take the at the money straddles, for instance, you add up those two here. If you want to buy a put and buy a call at the same rate, you're still pricing it in at a little over 50 points, which is very little, which doesn't say that the option market is very worried about what's going to happen on the Bank of Canada, and as a matter of fact, not even over the US GDP. I'm going to have a quick look at it, because this is a bit interesting, I think. These are mid rates, okay? So don't expect that if you have an options broker, don't expect to pay the sum of these prices. You're probably going to pay a bit more, all right? You're probably going to pay around the 55 or so, 56 pips mark. But still, I mean, this is still relatively interesting. especially that it covers tomorrow's US GDP as well. No, am I saying something stupid? It is tomorrow, right? The GDP. No, it is tomorrow, the GDP. So I'm not saying anything stupid. Okay, that's great. So I just wanted to give you this one as well because it's on our page, and I know there's not many good FX brokers out there, especially not for the retail market. Okay, they are much wider than what the institutionals are going to pay up, and even if you want to sell options, which is not possible with all brokers either. They're probably not going to be as nice as what they do, but if you know how to trade them, if you have any experience with them, if you look at those things, this could be a bit interesting at times. Okay, and that's it for me for today, guys. I hope you are going to have a good time over the Bank of Canada. Keep an eye on that dollar. It is not dead yet. It is making a comeback. That being said, look at what the US yields are doing as well. The data are still supportive for the dollar, but we could just be in ranges and start to trade those ranges up and down. I know which side I'm off those. I am on those ranges, but hopefully you guys are all going to make a load of pips, and we talk to each other tomorrow again.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.